Channel. I'm Doris. I'm here to share with you about my stock account update. Today my stock account has made a loss of $1,414 US. Today US stocks closed lower on Wednesday. The Bank of Canada is still on hold again, and the next move could still be to raise interest rates. So let's take a look at my account. Right now the net asset of my account is $72,494.8. Today I increased my position in SPXU Pro shares, Pro shorts of S&P 500 ETF, and SQQ back to the shorts of Nasdaq. So today, Unity Software made a total loss of 6.14% to $28.9. And UNG, US Natural Gas, made a loss of 5.81% to $6.65 US. Right now, the market closed down with most of the industries closed with a mediocre fluctuation, and the tech industries and the auto manufacturers closed significantly with a loss of more than 2%. Dow Jones Industrial Average made a loss of 0.11%. Nasdaq Composite made a loss of 0.85%, and S&P 500 made a loss of 0.841%. US CPI rose 5% in March from a year earlier, the lowest two-year growth and below market expectations. The minutes of the Fed's March monetary policy meeting shows that the agency expects the banking crisis to trigger a recession this year. The Federal Reserve released the minutes of its March 21st to 22nd monetary policy meeting. The minutes showed the Fed's expected impact of the U.S. banking crisis could plunge the economy into recession later this year. Minutes from the March meeting of the Federal Open Market Committee, including a staff report on the possible impact of the collapse of SVB and other turmoil in the banking sector that began earlier March. While Michael Barr, Vice Chairman of Regulation, calls the banking sector robust and resilient, economists say the U.S. economy is bound to be hit by the banking crisis. The Fed minutes said, given the assessment of the potential economic impact of the recent banking sector, the March meeting includes a mild recession later this year with a recovery in the next 2 years. Post-meeting forecasts show Fed officials expect a GDP growth of just 0.4% for the full year of 2023. Given that the Atlanta Federal Reserve Bank grew about 2.2% in first quarter, this means a pullback later this year. Fed officials concerned about the overall economic conditions remain high, especially given the banking sector. After the SVB bankruptcy and other two institutions, federal officials opened a new borrowing facility for banks and relaxed the condition for discount window emergency loans. The minutes notice that the plans helped the banks through, but officials say that they expect lending to tighten credit conditions deteriorate. The minutes said, even if these actions were taken, participants recognize that there is a great uncertainty about these situations will evolve. In addition to Fed minutes, U.S. stock investors also received the closely watched CPI inflation data on Wednesday. The BOS reported that the Consumer Price Index rose 5% in March from a year earlier, slightly below market expectations of 5.1% and 6% last month. The ninth consecutive year-to-year CPI growth fell from a 40-year peak of 9.1% in June 2022. U.S. core CPI rose 5.6 months in March from a year earlier, in line with market expectations of 5.5% last month. On a month-on-month basis, the U.S. CPI grows 0.1% in March, slightly below market expectations of 0.2% and 0.4% last month. U.S. Treasury hit new highs after the March CPI data, and the two-year yields fell as much as 15 basis points to 3.87% on the day. CFRA's Sam Stovall said, this data is encouraging because it shows that inflation is moving in the direction the Fed wants. But I don't think it's good enough to get the Fed to stop raising interest rates. We expect the Fed to raise interest rates by another 25 basis points at its May meeting. but it is certain now that the possibility of the Fed will not raise interest rates after its May meeting is looming. After the release of the CPI data, according to CME's Fed watching tool, the Fed will hold rates unchanged at 36.5% and a 63.5% chance of a rate hike at 25 basis points at June, and by June at 35.9%, with a cumulative rate hike chance of 25 basis points at 63.0% and 1.2 chance of a 50 basis point. Bond market traders stepped up their bets on the Fed rate cut by the end of the year and lowered their expectations of a May rate hike after the latest U.S. overall consumer price data shows that inflationary pressure eased. Short-term Fed Treasury yields fell, with the 2-year yield falling as much as 15 percentage points to 3.87%. The swap showed traders' expectation for a May rates rise fell back to slightly over 2/3, while December forecast shows the effective federal funds rate could be more than half of a percentage point below the current 4.83%. The interest rate for the December contract was 4.29%. Housing inflation was by far the biggest contributor to the overall CPI growth, offset the decline in energy inflation, which was negative 3.5% in March, and all major energy components fell. And the BOS said U.S. food inflation recorded 0% month-on-month, while the household food index fell 0.3%. Richard Flynn, managing director of Schwab UK, said investors may expect the Fed to stop monetary tightening cycle soon, and today's inflation data are likely to be welcomed by investors still. Inflation data are likely to be welcomed by investors. Still, inflation, while having fallen, is still well above the Fed's 2% target. U.S. San Francisco Fed President John Daly said on Wednesday that while inflation is still some way from reaching the Fed's 2% target, the economy may be able to slow down enough to meet inflation without further policy action. Richmond Fed President James Barkin said policymakers have more to do to curb prices after the latest data showed that U.S. inflation is still well above the Fed's 2% target. I certainly think our inflation is over the peak, but the test is not done, Balkin said. He sees signs that the demand is cooling, but does not want to declare prematurely that it has overcome inflation, noting that prices excluding food and energy remain too high. Last week's March non-farm payrolls data show U.S. economy added 236,000 jobs in March, while below the expected 239,000 increase. The unemployment rate fell to 3.5%, not enough to allow the Fed to pause rate hikes. Fed Chairman Jerome Powell had previously said that high inflation could even require the Fed to raise interest rates by 50 basis points. But as the Silicon Valley Bank on March 10th, and the many small and medium-sized bank collapses are in trouble, people increasingly worry about the Fed to raise interest rates on the negative impact of financial stability, forcing the Fed policy meeting on March 22nd cautious stance, rates by 25 basis points to 3.75% to 5%, and it points out that the tightening credit conditions expected to cause pressure on the economic activity, recruitment, and inflation. Bank of Canada is still on hold again, and the next move could still be to raise interest rates. On Wednesday, the Bank of Canada announced its latest interest rate decision, keeping the benchmark interest rate unchanged at 4.5%, with the central bank deposit and lending rates also unchanged at 4.5% and 4.75%, in line with market expectations. But the central bank said it was assessing the limits of interest rates and was ready to raise interest rates again. The Bank of Canada already took a lead last month, becoming the world's first major central bank to stop raising interest rates. Bank of Canada Governor John McCallum said he wanted to absorb the impact of the previous 8 rate hike cycles and will delay the further interest rates increase as long as the inflation fell as expected. In its statement, the Bank of Canada expects the inflation to fall rapidly around 3% by mid-2023, and then slowly return to its 2% target by the end of 2024. The Bank of Canada said it was ready to raise interest rates if necessary. At a monetary policy news conference, McCallum said interest rates may be needed may need to remain high for some time. He noted that the committee discussed the need to keep interest rates higher for longer time. Market implied rates expectations suggest that the Bank of Canada will cut rates later this year, but in our view, this is not the most likely scenario. McClellan believes Canada needs to experience a period of low growth to contain inflation, but we don't expect a large contraction. The growth outlook hasn't changed much. Their benchmark forecast is positive, but weak growth and inflation will fall. On the side of the economic growth, the Bank of Canada sees real GDP growing at an annualized rate of 2.3% in the first quarter, and annualized quarterly GDP will average below 1% for the rest of the year. On inflation, the central bank said in a statement that it expects average inflation to be 3.5% in 2023 and 2.3% in 2024. Reducing inflation to 2% could be difficult as inflation expectations are slow and service price inflation and wage growth remain high. The central bank also cited pressures from banks as global slowdown, which poses the biggest downside risk to the Canadian economy. BMO Capital Markets chief economist Doug Porter said BOC has sent some signals of possible future policy tightening, but overall we still expect the central bank to keep rates unchanged for quite some time. According to discordance, analyst Royce Meads, the next step is expected to remain a rate cut as the lagging effect of the past monetary tightening began to play a role across the system. But central bankers are still on the sidelines. Mendes said, controlling inflation has shown some signs of progress, but there is still much work to be done that could take the rest of the year. He added that the Bank of Canada decided to keep its policy rates unchanged, admitting that the banking turmoil abroad has created some unforeseen challenges, but suggested that the domestic economy was able to absorb them without causing unnecessary pressure. That's all I have today. Thank you for listening. Don't forget to subscribe and like. See you next episode.